Hey, welcome back to Compounding Quietly. Most long-term investors eventually come back to SCHD, not because someone told them to, but because at some point, the market forces you to rethink what you're actually building. Let's get into it. There's a version of long-term investing that looks confident from the outside. You pick an index fund. You set up automatic contributions. You stop checking prices every morning. And for a while, that system works exactly the way it's supposed to. But then, the market drops, or it stays flat for longer than you expected. And suddenly, the strategy that felt solid starts to feel uncertain. You start wondering if you're in the right place. You start asking whether you should hold, wait, or make a change. This is where most investors begin to drift. Not because their strategy was wrong, but because they never had a clear reason to hold on to. They had a position. They didn't have a purpose. This distinction shows up again and again in long-term investing. The investors who stay are rarely the ones who chose the best performing ETF. They're the ones who understood exactly what they were building and why. They had a structure that kept making sense even when the market didn't. Here's the thing about long-term investing. If you don't know what you're waiting for, every down period feels like a warning. If you do know what you're waiting for, every down period feels like a pause. That's the difference SCHD tends to make for a lot of long-term investors. Not as the only answer, but as a structure that gives your waiting a purpose. The question isn't whether SCHD is the right ETF. The question is whether you understand what role dividend growth plays in a long-term portfolio, and whether that role actually matches what you're trying to build. SCHD tracks the Dow Jones U.S. Dividend 100 Index. It focuses on companies with a consistent history of paying and growing dividends, not the highest yielding companies, the most sustainable ones. That distinction matters more than most investors realize. High dividend yield sounds attractive on the surface, but high yield can sometimes signal a company under financial stress, a business that is paying out more than it can comfortably afford. SCHD doesn't chase yield. It selects for quality, consistency, and the capacity to grow that dividend over time. Think about what that actually looks like in practice. You own a piece of dozens of companies that have committed to returning cash to shareholders year after year, not only when the market is performing well, not when they feel generous, as a fundamental part of how they operate. And as those companies grow, the dividend grows alongside them. Most investors, when they first look at SCHD, focus on the current yield. They compare it to a savings account or a short-term bond, and sometimes they feel underwhelmed. The yield doesn't look dramatic. It doesn't feel like a reason to get excited. But that's the wrong frame to bring to this conversation. What SCHD is building is not a fixed return. It's a growing one. A dividend stream that becomes larger over time, even if you never add another dollar. That compounding effect is quiet. It doesn't feel exciting in year 1 or year 2. But by year 8 or year 10, the income generated from the same original investment looks meaningfully different than it did at the start. This is a good moment to come back to the original question. Why does SCHD matter for long-term investing? Not because it outperforms growth-focused ETFs every year. It doesn't. Not because it offers the highest yield available in the market. It doesn't do that either. It matters because it gives a portfolio a second engine. While growth assets work on appreciation, SCHD is quietly working on income. That income doesn't vanish when the market pulls back. If the underlying companies remain financially healthy, the dividend keeps arriving. And in a difficult market period, that kind of regularity does something important. It makes it easier to hold. There's a psychological dimension to long-term investing that rarely gets enough attention. Most investors don't fail because they chose the wrong ETF. They fail because they couldn't hold long enough for the strategy to work. SCHD gives investors something to feel while they wait, not just a number moving up or down on a screen. A dividend that shows up, grows, and compounds quietly in the background. That experience of regular and growing income changes how you relate to your portfolio. It shifts the focus from price movement to process. And when your attention is on process, the short-term noise of the market becomes easier to set aside. Long-term investing is not about finding the perfect ETF. It is about finding a structure you can stay inside of. SCHD is not a shortcut. It is not a guarantee. But for investors who are building over a long time horizon, it offers something genuinely rare, a reward that grows without requiring you to time the market, a reason to keep going when the portfolio feels flat, A reminder that compounding doesn't always look like dramatic returns. Sometimes it just looks like a dividend quietly arriving in your account, smaller than you expected at first, larger than it was last year, and reliable in a way that makes holding feel less like a test of patience, more like a choice you already understand. If you've been thinking about whether SCHD belongs in your long-term portfolio, I hope today gave your thinking a little more structure, not a recommendation, just a clearer set of criteria. And sometimes that is exactly what you need before making a decision. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.